Hello, everyone. So, what's going on in the market this week? What you need to understand: July 20th, weekend, the summer is here, everybody's having a good time. The market also is having a great time because the NASDAQ is down 3.65% this week. That's the worst performance since April. The S&P is also down 1.96%. What is going on? What is the matter with the market? What do you need to be worried about? I'll tell you what. I'll tell you what's happening. I'll tell you exactly what's happening. And what's happening is, it's good news. Inflation is down. So this is how perverted the market is. Listen to this for a second. So when the market, the market gets scared because of inflation, right? So inflation goes up, they raise the rates, they meaning the Fed. And obviously, the market gets spooked because, you don't want high interest rates. High interest rates is no good for stocks. Why? Well, because, basically we're competing, high rates is competing with the return on stocks. Now, do you want 5% risk-free or you want 10% with lots of risk, right? So you want the 5%. So the money gets away. You're losing the money away from the stock with the 5%. But, well, then I want rates to go down, right? So you want rates to go down. Why? Because it's better. Well, the only way rates are going to go down is when things are cooling off. Okay, great. So I want rates to go down, which is what's going to happen because the economy is cooling off. And this week we had, some slow job growth. We had some decreasing economic activities. We have inflation going down. So that should be good news. We should be great. We should be investing more. Well, hold on. Because now it means that the economy is slowing down. Oops, but that's not good either. Do you see the perversion in what's happening? Do you see how difficult it is? Depending on how you're looking at it. If you're looking right, it's happening on the left. You're looking at left, it's happening on the right. And that's the difficulty of the market, which is great, which is fantastic, because that's how you make money. You want that flexibility. You want this thing to go back and forth, back and forth, back and forth. So what's happening right now? The market is down because they're saying, hey, you know what? Things are slowing. The market is slowing. Stocks are going to not do well. Not all stocks, but obviously the tech stocks, right? Because you were looking for some growth, and you're going to get it from the tech stocks. But now, with everything slowing down, they're saying, maybe we should be a little more defensive. Maybe we should be looking something more interesting. Maybe we should go into the defense stocks. Maybe we should be looking for value, right? I mean, I don't know if you've seen it, and I'll do something. I'll show you an example. But basically, based on my calculation, let's say NVIDIA, right? For this company to sustain the $3 trillion in $3 trillion in valuation in the market cap, you are looking at 46% growth. That's a lot. That's a lot of growth. I don't think you're going to get that much growth from a company at this level, right? So what you want to do is you want to slow it down, but you can't because everybody's buying. And now they realize, hey, listen, 46%, really? Is this thing going to grow that fast? I don't think so. So therefore, what do? Well, you're pulling out because now you want to be more defensive. Now you want to be more value oriented. Now, of course, it's easy to say after the fact, right? You want to get it on before that happens. You want to know what to do before. But that's okay because obviously now with this new paradigm, which is rates are going to come down, which means the economy is going to slow down, which means let's watch out a little bit more and be a little more defensive. Let's buy stuff that people really need, and let's make sure that we know what we're buying, meaning intrinsic value is going to be more important. What is intrinsic value? Well, that's what something is really worth. If you, buy a house, probably the worst investment, quite frankly. I would rather rent, but you buy a house. And, how much is it worth? Oh, I don't know. I'm looking at this house, and it's worth 400,000, and next door is 400,000. So it's the same kind of house. So it's got to be worth 400,000 because that other one sold for 400,000. That's how much it's worth. Well, that's relative value. It's like a P ratio. Right? I'm buying 10 times earnings or whatever, and I'm comparing it that way. But what is the true value of the house? What is the true value of the stock? Well, the true value of a house is, I don't know, if I put all the concrete and the wood and the stuff that went into building it, maybe that's the value. But that was 50 years ago, 30 years ago, 20 years ago, last year. But what is it worth today? It's only worth what someone is willing to pay for it. That's a problem. And people are very, 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 very fickle. People are fickle. Why are they fickle? Because they act on emotion. Why do they act on emotion? Because that's how we're built. What do you mean by that's how we're built? Well, essentially, your mind and your body and your being and the whole race is basically all about surviving. And how do you survive? You save your energy, right? You don't run around all day for no reason, exhausting yourself to death without eating, right? You're always surviving, you're always eating, and you're always waiting, and it's in you. You don't want to die. Basically, you want to survive. So how do you do by doing that? Well, you conserve energy. The only issue is by conserving energy, you also conserve energy in your brain. Hold on, I'm not crazy. Let me finish. You're conserving energy in your brain. That means that your brain is basically saving and not telling everything that's going on. Your brain, in terms of emotion, is essentially predicting what it thinks, projecting what it thinks is happening. Maybe it's not really happening, but it's easier to say, you know what, I think we're going to be fine. I think we're not going to be fine until, instead of finding out everything that you think is going to happen and analyzing all the possibility and spending 3 days and say, okay, you know what, I'm going to have this piece of cake. That takes too long, right? So, and that's the issue. And that's what's happening with the market. The market is always saying that way. The market is always assuming. The market is scared. And that's this is a human condition. So what does that mean for you? As an investor, in order for you to make money, you need to understand that. But how do you make money? Right? Because now, obviously, NVIDIA, take it easy in terms of it going up, right? It might not be the case anymore. People are going to be reacting. So what do? Well, what you need to do, you realize there's going to be volatility. Why? Well, because right now, are they going to lower rates or they're not going to lower rates? I don't know. Is the economy really slowing down and unemployment really, is it yes, no? So what do? You hedge. You protect your book. How do you do that? Well, it's very simple. You just go for the options market. So you could benefit when the market goes down. You keep your portfolio, but you hedge your way down. Remember, at the end of the day, you don't want to always be looking for the gain. You don't want to look for the next NVIDIA. Why? Because things don't always go the right way. Things don't always go up. At some point, it starts to slow down. Right? So, and since there's volatility, you want to benefit if there is a bit of a dip somewhere. I mean, don't forget, the 3.65% down for the week, that's a huge amount for NASDAQ. If you had put a put on this last week, you would have done very well this week. Of course you didn't, because you didn't know that the economy was going to go down and you didn't know what everyone else was going to do. That's the question. What is everybody else going to do? As an investor, you need to get a feel for it. So, but you know, overall, the big picture is we are going to have some rate decrease. That should push stocks up technically, but it doesn't mean every single stock. Now, obviously, the defensive stock might be doing better. The value stocks might be doing better. So what do? Well, you start looking into value and you start looking for intrinsic value. What do we mean by intrinsic value? Intrinsic value is basically what this thing is worth. And if you believe in Graham, which I do, you know, the future value, the present value of stocks is the future value of the cash flows. What is the future value of the cash flows? Well, how much money they're going to be making. Okay, so if you know how much money they're going to be making in the future, you discount it back and you get to the value as of today. So how do you make money? Well, you make money by basically making sure that the stock price that you're buying for today is less what you think the intrinsic value is. What is intrinsic value? Well, you need to know what the cash flow is going to be and you need what the rates is going to be. But don't worry too much, because you know rates are going to go down. If rates are going to go down, stock is going to go up. The point is where, which industry. Now, of course, you could say, well, let me buy a fund, so I don't have to worry about too much. Yeah, but you know what? More likely than not, 30% of the time, you're not going to beat the market. You're not going to be above the S&P 500 because most portfolios don't beat the market. Why? Well, because inherently, even if they buy NVIDIA, they're not just going to buy NVIDIA and hold it and have it 90% of their portfolio. They can't do that. They get fired. That's too much risk. So they automatically have to unwind that position and say goodbye to the profit on NVIDIA. They have to let it go. They have to realize that it is not going to be that way. So then what's the alternative? Well, the alternative is you have to pick your stocks. But again, we're back to the thing that I always say. But you need to know what you're buying. Do you know what you're buying? Do you know? Do you understand the stock? So take a look at the stuff that I did on Tesla, right? I kind of explained that Tesla, mostly right now, it's all about cars, but it's also about AI, it's about robots. But how much robots? How much AI? You need to know that. NVIDIA, what do? Well, they have a great customer base. They're doing a lot of interesting things on AI, which is good. And they're very diversified and they're growing. The only problem is NVIDIA in the game is up. The game is up because it's already up a lot, and the inherent expected increase in the stock is 46%. That is a lot to keep it up. I remember at one point, Netflix. Remember Netflix? Netflix had a P ratio of 125 about 4 years ago. That's because they were doing the stuff that they were doing with what were they working on? The House of Cards, and they were getting involved beyond the DVD. They were producing stock. They were producing movies. Right, so at that time there was lots of growth, like Nvidia now. Right, the market is thinking, hey, this thing is going to grow up forever and ever and ever. You need to get it on before the growth. And I have to tell you is when you see a lot of people saying, oh, Nvidia, it's too late. They're already talking about it. You need to get on before the people tell you about it. You need to get it on before. But how do you do it? How do you know what the next stock is going to be? Well, it's simple. Just look at all the stock and start analyzing yourself. I will help you through my channel. I will start reviewing one stock at a time and one stock at a time. That's going to keep me busy, but it's going to give you at least the tools in order to understand which stock that could do well. Now, obviously, it has a lot of stocks, a lot of possibility. And obviously, it's a lot easier to say, "Hey, Tesla," when everything was going great. I mean, take a look at all the videos of all these people telling you what to do. Okay, take a look at all of them, and they will say, "Buy Nvidia," when the thing is going up. But that's easy to do, easy to say, and then you say, "I don't know anything, so I want to make money too." What you need to realize is that you need to buy when everybody's selling. Maybe you should be buying Nvidia now when everybody's selling. Or wait until the bottom. Of course, who knows what the bottom is? Nobody knows. Okay, and frankly, you're not going to win all the time. So the best thing for people that don't know anything is you just buy and hold for a while, and you keep investing, and eventually you kind of average out at 10, maybe 12, 13, 14%. Now this is purely for entertainment purposes, like all these other YouTube channels. It's entertainment purposes because they cannot tell you buy the stock. It's like saying, go kill yourself. You're going to get into trouble at some point. So they say it's entertainment purposes, and I feel bad because a lot of you don't understand this market, don't know this market. It's a complex. I've been teaching this stuff. I've been investing. I've been buying and selling houses all the time, and how does it work? Frankly, I've done much better in real estate than in stocks because you cannot be right in stocks all the time. Why? Because the nature of whomever is trading it is always changing. There's about on average 250,000 people, traders every day in and out of a stock. How do you know all these people think? Having said that, I will tell you that in 1987 there was a stock market crash where the market dropped down by 20%. So they went out and Schiller, at that time. He was a professor over at Yale, and he did an analysis, and he did a survey. He surveyed all these people in the market, and they said, and he asked, hey, why did you sell on this day, October 19, 1987, where the market went down 20%? There was no single event. It's not like somebody died or somebody killed himself or somebody destroyed something or whatever. No, none of that. Something, they just felt there was a lot of pumped up demand and they decided to sell on that day. That's scary, right? Because you don't really know what's driving the stock market. In the stock market right now, you got two train of thoughts. You got either a price risk, which is the risk of, which is basically what the beta is measuring. Beta for our friend Nvidia is around. The beta for Tesla is around 2.6. So that means that when the market goes up, Tesla goes up twice as much, which is great. But also when it goes down twice as much as well. But this volatility is just a price volatility. Then, on the other end, you have how much money the company is making. What is the credit risk? Are they talking to each other? Well, for the consumption of everybody out there, they will tend to make you believe, or they will tell you that there is a relationship between the two, right? Because if you're making money, the earnings are coming up, and look what happened this week, right? We had some sort of a slow growth in the market, in job growth. So they're assuming that's going to impact the earnings, and therefore it may impact the stocks. Is that what's really happening? Who was the most successful trader of all time? Who made the most money? Jim Simmons, 30% every year for like 20 years. And you know what? This guy, Jim Simmons, you can look it up. He was a mathematician. He wasn't a finance person. He didn't learn about the finance. He didn't study the earnings. He looked at price risk. What does that mean? It means that the solution of where stocks are going to go are tied to the movement of stocks. The movement itself. Exactly. Can you predict where clouds are going to go? Can you predict the formation of... Can you measure the coast of England? Right? You can measure, right? You just go and measure. You can measure it. I hate to tell you, Google it or ChatGPT it. You cannot measure the size of the coast of England, because the smaller and the closer you get to the measurement, the more it gets complicated. Why? Well, because what are you measuring it with? As you get closer and closer, you see more and more details. And sometimes you won't have a ruler because the stuff is so small you can't even measure it. But yet the closer you get, the smaller you get, the more there is. Take a look at it. Google it. The Mandelbrot set. And you're going to see Mandelbrot that you cannot measure it. And yet it's there. And Mandelbrot, which is a famous mathematician, did say that the same thing could be applied to stock market. It looks like you could measure it, but you can't. So I see a lot of YouTubers out there talking too much and saying lots of different things. But unfortunately, not all these things are true, because they're much more complicated. But keep in mind that if you're on YouTube, it's really for entertainment purposes, right? Somebody puts a microphone like I do, they go in their backyard and they're talking about what they think is happening, and you're listening. But this is entertainment. This is not real. Keep in mind, this is entertainment. It is not real. Some of them might make sense to you, so therefore you will tend to listen to what they have to say. Some of them you probably don't understand because you don't like what they're saying, so you're tuning out. And you tuning out doesn't make too much sense. But at the end of the day, what you want to do is you want to understand what you're buying. But that's true in anything. You're not going to buy a house without looking at it. You're not going to buy a car without driving. So why would you buy a stock not understanding it? Yet, what's funny is when you look at medicine and you're looking at financial, people will just say, I don't know anything. They will negotiate a car to death. They will drive the car. They will sit in it. They will look at the color. They will complain that's too much money. But yet they go to the doctor. Okay, doctor, whatever you say, I'll do it. Or you go to a financial person that frankly may not even be financial. Oh, you told me to buy? I'm buying it. Because you have a lot of followers, so you can't be wrong. Why is it? Why is it that people don't understand? Why is it that people are more trusty of their own when it comes to a car than to finance and medicals and medicine? It's easy. They don't understand. A car, you know what a car is, right? You know how to drive it. You know what you need to go. You know how to go in and out. But when it comes to finance, when it comes to medicine, you don't know. So therefore, you say, well, let me pay someone, or let me listen to someone else's decision, and you realize that they don't really know at the end of the day. So you're relying on them. But yet these are important decisions. Your health, right? Did you know, for example, that health-wise, more people actually die from taking medicine than anything else? Yes, a lot of people take the wrong kind of medicine, or too much of it, or not enough. So this stuff is, and forget, when I say medication, they test for the effectiveness of the medication, but they never test for the impact after you're taking. I mean, they test the impact when they're testing the drug or the medicine, right? But after, when it's in the market, they don't call you back and say, hey, how did that work out for you? Well, we did a test with a bunch of people and nobody died, so we should be okay. No, you don't know how they did the test or whatever, right? But why are they doing it? To make you healthier? No, they're making it because they want to make money. Not that they want to kill you, because they obviously don't want to give you something that is not good. But so that's kind of the same thing with finance. In fact, it's worse. No, why do you think there are so many billionaires in finance? Because there's people like you that really invest when they don't understand anything, and you figure, well, I mean, and they take advantage of you. They wait for you to come in. Like right now, a lot of people got taken advantage of because of 2 weeks ago, Nvidia, oh, it's going to go up, let's buy Nvidia. Can't be wrong, everybody else is buying it. Look what happens. I was seeing some video where some guy basically said, let me show you how to retire in Nvidia. Really? You're going to retire in Nvidia with one stock? Do you know the risk there is in one stock? And that's the other thing also, is most people focus on the return. Why? Well, because I know if I make 50%, it's more than 40%, but it's less than 100%. I could measure these things. I could understand them. But do you understand risk? Right? You don't understand risk. What is risk? Risk is uncertainty. What is the risk of buying a stock? Of not making 100%? No. The risk, the volatility, right, of the stock. Yeah, on average, you're going to be, maybe the average is 15%, two stocks, 15%, 15% average. But one has a huge volatility around the 15%, and one is like that. Do you want this or you want that? Because the average is the same. So you want this. Where do you find this? How do you know this is a price volatility? That's what you want around my 15%. That's what I need, because you could be buying here and then going down and selling, and you're down and you're off. You want this. You want very small amount of standard deviation around the mean. Where do you find that? Well, you could look at what has happened in the past, which is basically what the beta does. The beta gives you that. It gives you this kind of volatility. It's not standard deviation, it's different kind of calculation, but it kind of show you the volatility and the market, how it moves with the market. So that's good. Move around the market. The problem is the beta assumes a certain type of risk, which is the systematic risk. It's a risk that basically, the risk such as inflation, a risk that impacts everyone. That's the only thing that's measuring. It assumes that all the other risk, like specific to a company, is gone. Really? For 500 stocks? Because if I'm buying one stock, is offsetting another stock, therefore there's no risk at all? Yeah, but you're still impacting inflation. Yeah, but does it mean that the risk that let's say Nvidia is going to file for bankruptcy, for example, versus the risk that GM is going to file for bankruptcy, are they offsetting each other 1-to-1? How do you know? So therefore, you can't really rely too much on the beta. So you can't really measure the risk, and that's a problem. But even if you could measure the risk, and probably half of you probably don't understand what I'm talking about. right? What the hell is he talking? Risk, standard deviation, beta. It's too confusing. I don't want to know. I'm out of here. Exactly. So then you'll focus on the return, and this is what return. Look at all the video you're saying. It's all about the return. How much money can I make? What is the best way for me to do the return? But yet, no one is focusing on the risk. When you cross the street, don't you look on the left and on the right? Right? You look. You don't just walk out. Why would you do the same thing with stocks? Okay? So keep all that in mind for today. So the end result is this. A, the market took a bath this week. B, which is bad. B, inflation is coming down. That's good. Market is down. That's bad. Tech stocks, be careful. That's bad. But we may have a shift into defense and a shift into value, which is good because that's easy to calculate. And that means the market is volatile. That is good. If the market is volatile, you could profit by, remember, straddles. Work on some options. Go up and down. Don't forget, subscribe to my channel. Say you like it. That's important. That's what pays me every day.